Hello friends, welcome to March June 2019 SBR paper question number 2. So as you can see the subheadings, even without reading the whole case study or any of the requirements, you can have some idea what type of questions can come. As we can see from the subheading, we have redundancy and settlement cost, right? So redundancy and settlement cost, it comes under which IFRS or IAS? Redundancy is related to what? Employee benefit? It could be your IAS 19. And tax losses, it is your IAS 12, right? But that's not it. We can have more IFRS and IAS inside the main one, but at least the subheadings will give you some idea. So now let us read the requirements. A, explain why the directors of Hudson are wrong to classify the basic settlement and additional pension contributions as part of the remeasurement component. That is the first part of the requirement. When you read the requirements, don't read it as one sentence. That after that comma, that's another requirement. So you have to keep a pause over there to understand that this is one requirement and the after comma is the second requirement in one. Okay, including an explanation of the correct treatment. So it's not only that you have to say why it's wrong, you also have to give what is the correct treatment for each of these items. Also explain how any other restructuring cost should be accounted for. Now you can see there are three requirements in part A for 8 marks. First, you have to explain why the directors of Hudson are wrong. You have to explain why they are wrong to classify basic settlement and additional pension as part of remeasurement component. That is one requirement. Second, I will take a different color. Maybe here I will put different color. Explanation of the correct treatment. So next is uh, explanation of the correct treatment for each of these items. Each of the items means the settlement and the pension contribution. Third, I will put a different color maybe. Yeah, green. So third is uh, restructuring cost. How restructuring cost should be accounted for. So I have underlined using three different highlighter for you to identify that yellow is number one, orange is number two, green is number three. Three requirements. And when you answer such requirements where you have more than one in one requirement, single requirement, answer one by one. First, finish the yellow part. Next, think about the green, orange, and then think about the green part. Now coming to part B. Explain whether a deferred tax asset can be recognized in the financial statements of Hudson in the year ended 31st December 2002. For 5 marks. Explain. So, so your uh, calculation is not enough. You have to explain whether there will be deferred tax asset will be recognized or not. And you know under IAS 12 this is. The deferred tax asset is not always recognized. It is recognized if certain conditions are met. What are those conditions? Basically, that only you have to tell in this answer for 5 marks. Whether it will be recognized or not. They have given you the year 31st December 2002. Next, part C. Part C is your ethical questions, right? Your ethical question you will be asked in SBR. There is no escape from that. Number of marks, it depends. It could be for 10 marks, it could be for 5 marks, it could be for any marks, right? And it will come in question number 2. So your professional marks also is in 2, question number 2. So identify any ethical issues which arise from the director's proposed accounting treatments and behavior. Your answer should also consider that. See this word also. Your answer should also means addition to what you're supposed to do, you also have to include this. So your answer should also consider the implications for the accountant arising from the director's behavior. Now when you read the ethical answer, when you go through the answer, it looks very easy. You are like, okay. Because what happens is most of the candidate, when they are preparing for this ethical questions, they read the answers, they try to memorize it, and they try to they try to fit that in any ethical questions which they get. That's not a right approach. Ethical questions, specifically the ethical questions, a student must write in your own words because every ethical question is different. Other questions, like where you have to, let's say part A and B, this type of questions, okay, we have a specific answer. So standard answer is there. Answer will be the same for all the students. Answer has to be same. The only way is the words they are using might be different. The sentences where they are using. Maybe some students are using three sentences to explain. Let's say IS 12, why deferred tax has to be recognized. Some are explaining in one single line. That is the only difference. But answer will be same. But part C, ethical question, variety of answers are available there in part C. That's why it's very important that you write ethical answers. It's not easy to write ethical answers. Trust me on this when I'm saying this. From experience, I'm telling you this. Where you have to apply certain IFRS or IAS is easy because you know these are the rules. Okay, you go by the rules, you memorize, and you write it. But ethical question is not like that. It's very difficult to write ethic answer, even if it's for 5 marks. So please pay attention because your professional marks are also there. You don't think this professional mark is just 2 marks, is nothing, it's just a pain, remember the difference between failure and pass could be just 1 mark. You might just be failing at 49 and wondering maybe this professional marks might help you to get that one additional mark and make you pass. So never underestimate the power of professional marks even if it's 2 marks, because candidate, if you know you by yourself, you are seeing your friends or you must have failed by just 1 mark. Most of the students are failing from that 45 to 49, that range. So it's not that a student is not capable of or does not have enough knowledge or they didn't prepare or they are not good enough. The reason why students fail in ACCA is the lack of the way they prepare, their application. They have vast amount of knowledge but the application is very poor. Time management, interpreting the case study, understanding it, professional marks, not taking care of the professional marks. These are few reasons why students fail. So please learn from these mistakes and make sure that you are not the next one who fall into this trap. Okay, so coming to A. Okay, now let us read the case study. So background, always start with the background. Hudson has a year end of 31st December 2010 operates a defined benefit scheme for all employees. In addition, the writers of Hudson are paid an annual bonus depending upon the earnings before interest, tax, depreciation, amortization, that is EBITDA of Hudson. Hudson has been experiencing a loss of a number of years and his draft financial statements reflect a small loss for the current year of 10 million. This is very important. When a company is experiencing losses for a number of years and loss current year is 10 million. On 1st of May 2002, Hudson announced that it was restructuring and it was going to close down division. On which date? 1st of May 2002. When it comes to restructuring, date is very important. It announced that it was restructuring and it was going to close down division. How do you pronounce it? Okay. So a number of redundancies were confirmed as part of this closure, with some staff being relocated to other divisions within Hudson. So some of the staff has been relocated. The directors have approved the restructuring in a formal directors meeting. So directors have approved. And Hudson is highly geared and much of his debt is secured in covenant which stipulate that a minimum level of net assets should be maintained. For your ethics part, this might be very important fact. When you're reading your case study, please look at as an whole, okay, integrated purpose. Don't read it in isolation. Like, let's say you're only looking from the point of part A. So it's not only about your restructuring, it's not only about your tax losses, It's not only about ethics. It is a combination of all these three. So when you're reading also, keep that in mind. So as soon as you're going through, wherever it is applicable for whichever requirement, just keep underlining it. It might not be for part A or part B, but it might be for part C. Or sometimes it might come for more than one requirement. Let's say this answer could be applicable for part A and C or part B and C. So Hudson is highly geared. When you're reading, please, these are very important facts, key facts. This is how you analyze, you understand that these are the key facts that I have to underline. Most of you, when you're reading, you think it's not important, you just over overlook it, right? So don't do this. Highly geared, much of his debt is secured on covenant, because this all leads to your ethical issues. Remember that when you are highly geared, when you are near to breaching your debt covenant and all, right? So minimum level of net asset should be maintained. Directors are concerned that compliance with IFRS could have simply significant implications for their bonuses and debt covenants. Another key issue, directors are concerned that compliance with IFRS have implications for bonuses and debt covenants. So they are saying, the directors are trying to say that if they comply with IFRS, then this can have an effect on what? Negative effect on bonuses and debt covenant. Maybe you will breach your debt covenant, so you might not get enough debt. This will also have an impact on your bonus. Maybe you might not get bonus if you comply or follow IFRS. Redundancy and settlement cost. Hudson still requires a number of staff to operate division, let's say V, until its final expected closure in early 2003. So early 2003, it is the final expected closure. As a consequence, Hudson offered his staff two settlement packages in relation to the curtailment of the defined benefit scheme. Okay, so one is a basic settlement, was offered for all staff who leave before the final closure of division. And additional pension contribution were offered for staff who remain in employment until the final closure of division. Now, the directors of Hudson have already included an adjustment in the financial statements for those staff who left before 31st December 2002. Directors have already included adjustment for staff who left before 31st December, this one. Only for the staff. So the directors have included these adjustments within the where remeasurement component of the defined benefit scheme. They do not wish to provide for any other settlement contributions until employment is finally terminated, arguing that an obligation would only arise once the staff were made redundant. On final termination, the directors intend to include the remaining basic settlement and the additional pension contribution within the remeasurement component. So the directors and the accountant are aware that the proposed treatment does not conform to directors and accountant both are aware it does not conform to IFRS standards. So an ethical issue again. Being aware they are doing this. So directors believe that the proposed treatment is justified, so they are justifying this treatment, even if it's not complying with IFRS, as it will help us maintain his debt covenant obligations and will therefore be in the best interest of their shareholders, who are the primary stakeholder. The directors have indicated that should the accountant not agree with the accounting treatment, then he will be replaced. Accountant will be replaced. Now coming to the tax losses. So before coming to the tax losses, since tax losses comes for part B, I'm just going to work on part A now. Okay, why basic settlement and additional pension contribution as a part of remeasurement component is wrong. That is the first thing. Then I'm going to explain the correct treatment for both basic settlement and additional pension. Then I'm going to explain how restructuring cost should be accounted for 8 marks. So let us go to the answer. Now if you read your answer A, just see answer A and B. They didn't separate which is the correct treatment, which is the wrong treatment, which is the for restructuring. Okay, but you have to divide your answer in separate paragraphs. By the different paragraphs, I will understand. When you read the first line of a paragraph, you will understand this paragraph is for what, which part of the requirement. So now you have to say why it's wrong. So the remeasurement component is taken to other comprehensive income and compromises. Okay, you have to say what is there in the remeasurement component. Actual gain and losses such as the return on plan assets, which differ from the expected return on assets included within the net interest figure. Changes in the asset ceiling not included within the net interest calculation. This are from your IS 19. Please read your IS 19 if you are not very thorough with this. IS 19 is a big standard and it's a little bit, it's an area where students can get confused. So you have to, memorization is required. A lot of memorization is required here. How each element is dealt in IS 19. So actual gains and losses sometimes referred to as experience adjustments and arise due to differences between actual assumptions and what actually occurred during the period. Okay, this is from the standard itself. You will understand. This will arise in instances such as the unexpected movements on interest rates. So they are saying how this movement is there. Why this difference? One is unexpected movements on interest rates. Unexpectedly high or low rates of employee turnover, or unexpected increase or decrease in wage growth. So the redundancies will create an unusually high level of staff turnover, but this should not be treated as part of remeasurement component. Right? Even though redundancies, what happens is it will leave a high level of staff turnover, but they should not be treated as part of remeasurement component. The redundancy will cause the present value of the obligations arising from the defined benefit to decrease. Exactly. Because of redundancy, since most of the employees are now leaving, redundancy means what? They're leaving. So what happens? Your obligation, present value for the obligation, you're obligated, right, to pay your staff some benefit, that will reduce because staff are leaving. So the staff who are leaving, you don't have to pay them. That's why defined benefit will decrease the redundancy, right? The present value of the obligation, which is arising from the defined benefit, will decrease. So this is classified as a curtailment rather than experience adjustment to be included within other comprehensive income. That's why. So this change, this decrease, it is what? It is classified as what? It is classified as curtailment. It is not an experience adjustments which could be included within other comprehensive income. Because where is a remeasurement component is taken? It is taken in other comprehensive income only. So your other comprehensive income, this word is key. You have to mention it. Now, when you're talking about this, you have to mention about IS 19, employee benefit. You have to talk about you have to bring the standard here. A distinction between needs to be made between basic settlement and additional. Yes, it's a difference. Basic settlement and additional pension contribution. First, you have to differentiate these two. The basic settlement is an obligation which Hudson has to pay as a compensation for terminating the employee's services regardless of when the employee leaves the entity. Understood? IS 19 employee benefits require such payments. So what does IS 19 says on this basic settlement? It says that it requires such payments to be recognized at the earlier of when the plan of termination is announced and when the entity recognizes the associated restructuring costs associated with the closure of this one. Whichever date is earlier, they have to recognize the payment. Which payment? Basic settlement payment. The day when the plan of termination is announced, or entity recognizes the restructuring cost which is associated with the closure of that department. Whichever date is earlier, you have to recognize the payment on that day, the basic settlement. So the company should therefore have provided in full for the cost of basic settlement regardless of whether the staff have left or not. This should be recognized as part of past service cost in the P&L of Hudson for year end 31st December 2002. So this is the correct treatment you are saying. I will take orange. So the basic settlement recognized as part of past service costs in P&L. This is the correct treatment of basic settlement. So first they are finishing everything about basic settlement and then they are switching to the additional pension contribution part. Now, so the additional pension contribution is only paid to employees. This is not paid to all employees. This is paid to employees who complete service up to the closure of division. Since it is expected in early 2003, there should be accounted for a short-term benefit. In effect, the contributions are in exchange for the period of service until redundancy. Hudson should estimate the number of employees who will remain with Hudson until the closure of this fund. They should estimate. So the cost of this payment should then be spread over the period of service. All these are in IS 19. There's nothing new I'm talking about here. If you are very thorough with IS 19, you will understand this is nothing for you. Since this should be included within the current service cost. That was past and this is the current service cost. This will have an adverse effect on the P&L in both 2002 and 3. In line with the criteria. Now, remember there is one more IAS 37 you have to talk about. In line with the criteria to recognize any provision as set out in IAS 37. Because where do you recognize provision? Under IAS 37 only. An obligating event must have arisen for a restructuring provision. Because you're talking about restructuring, where it will be recognized, you have to talk about IAS 37. Okay. And for the associated restructuring cost to be recognized, furthermore, specific conditions must exist for such an obligating event to have arisen in relation to restructuring provision. What is it? You cannot just recognize restructuring provision, even though restructuring is taking place. There are two conditions which has to be met. Under IAS 37, go through IAS 37. By the way, I want to inform you that IAS 37 is a key IAS. That is also an area which is very, very frequently asked. I think every examination has IAS 37. Some IAS and IFRS is very frequent. Like you will know by looking at it, the nature of it, it always comes. IAS 37 is one of that. So please thoroughly go through IAS 37. There's a, I would say 99.99% that you will get an IAS 37 in a question for SBR in this June exam. Right? I've never seen a paper where IAS 37 has not been mentioned. Okay. So IAS 37. So for what are those conditions? Let us read. This are the two conditions in two different bullet points. One is a detailed formal plan for the restructuring is in place, identifying certain criteria required by the accounting standard. There should be a detailed formal plan of the restructuring. And this and means what? Both conditions has to be met, not just one. A valid expectation has been created in those affected that restructuring will carried out either by starting to implement the plan or publicly announcing its main feature. So who is getting affected by this? The employees will be made redundant. They have to be informed, or they have to publicly announce in their board meetings or something like that, or maybe they have started to implement that plan. So this has to be there before you recognize restructuring provision under IAS 37. So in the case of the company, a valid expectation, is it created or not? You tell me. First you have to understand this. Is it created? From the case study, what do you think? I think it has been created. Why? Because in the form they have told in the directors meeting, right? Formal director meeting has been done there, and a confirmation has been given. The approval has been given by the director for the restructuring to go ahead. So a valid expectation has been created because the restructuring has been announced. Okay, I will underline this with a different color because this was the last part, no? Restructuring. So restructuring has been announced. The redundancies has been confirmed. See, they are using comma, very short sentences. Restructuring has been announced, redundancies has been confirmed. Directors have approved the restructuring in a formal directors meeting. Very short to the point. That also in the first few lines of that starting paragraph they're telling. Always your main points give in the first few lines of your starting of your paragraph. Don't wait till the end. You will beautifully go and then describe. You will not have that much of time. Come to the main point directly. Hit the point. IS 37 specifically sets out that a provision cannot be made where only a management or board decision to restructure has been taken, as it is not considered that this in itself gives rise to an obligation to restructure. This also you have to tell. This is another side of IS 37. Read IS 37, then you will understand. Where you can recognize a provision, where provision should not be recognized. Both you have to tell. So IS 37 also specifies that only the direct expenditure which is necessary as a result of restructuring can be included in the restructuring provision. Another thing, this also has to be there in your answer. This includes cost of making employees redundant. What does it include? Cost of making employees redundant, cost of terminating certain leases, and other contents directly as a result of restructuring. However, it specifically excludes cost of, what does it excludes? The cost of retraining or relocating staff, marketing or investment in new system, distribution networks, as this cost relate to future operations and so do not fall under the definition of a provision. Please make sure that not everything falls in your provision. Future operating losses will never fall in provision. There's no provision for that. Relocating staff, retraining, marketing, all this cost will not be there. Provision will not be made for this type of cost because they're relating to future operations, right? Thus, the cost of ongoing activities such as relocation activities cannot be provided for. Very important thing. This has to be there in your answer, right? So coming to part B now. For part B, we have to read about tax losses because part B asked how deferred tax asset, whether it will be recognized or not. So for that, tax losses will read. The directors of Hassan wish to recognize a material deferred tax asset in relation to 250 million of unused trading losses. How many? 250 million unused trading losses, which have accumulated as of 31st December 2002. Hassan has budgeted profit of 80 million for the year and a 31st. So for the next year, that means future, profit of 80 million. The directors have focused that profits will grow by 20%. They focus that profits will grow by 20% each year for the next 4 years. The market is depressed and sales orders are at a lower level for the first quarter of 2003 than they were for the same period in any of the previous 5 years. 5 years. It's not a big thing. Right? It's a very big thing, even though you think it's not. So the husband operates under a tax jurisdiction which allows for trading losses to be only carried forward for a maximum of trading losses can be carried forward for a maximum of 2 years. So now you tell. This is more like an explanation than calculation. You have to be very clear. Is it a calculation or an explanation? For 5 marks. Start by defining what is deferred tax. That's what they did here. So deferred tax represents the amount of income tax payable or recoverable in future periods in respect of temporary differences. Temporary differences. Mention temporary differences. Temporary differences are differences. Now define what is temporary differences. Temporary differences are differences between the carrying amount of the asset or liability and its tax base. Tax base, this word also will come in your answer. A deferred tax asset. So what is a deferred tax asset? Define deferred tax asset. A deferred tax asset arises. When does it arise? Where the tax base of an asset exceeds the carrying amount. So a deferred tax asset can also occur when the tax base of a liability differs from its carrying amount. The eventual settlement of the liability represents a future tax deduction. In relation to unused trading losses, now you are relating it to what? Bring it to the case study. Unused tax trading losses. The carrying amount is 0 since the losses have not been recognized in financial statements of the husband. Of course, if it's unused trading losses, so the carrying amount will be what? Carrying amount is 0. Losses will not be recognized in financial statements. So, right? So a potential deferred tax asset does arise, but the determination of the tax base is more problematic. It does arise, yes, deferred tax asset does arise, but tax base to determine it is more problematic. Now, next para says the tax base of an asset is the amount. What is tax base? Define tax base of an asset is the amount. All these are in your IS 19, please, sorry, IS 12. Please go through your IS 12. What is tax base? What is temporary differences? What is deferred tax? What is deferred tax asset? So a tax base of an asset is the amount which will be deductible against taxable economic benefits for recovering the carrying amount of the asset. When recovering of the asset, well, recovery of the asset will have no tax consequences. Tax base is equal to the carrying amount. Okay. Huston operates under a tax jurisdiction which allows. So you have to say under which tax jurisdiction the company operates, because under which tax jurisdiction the company operates, everything changes. Sometimes it could be for carried for 2 years, sometimes it could be carried for 5 years, sometimes they don't carry at all, so depends, right? So mention about tax jurisdiction from the case study. Here they are saying losses to carry forward for 2 years. So the maximum of the tax base could be therefore equal to the amount of the unused tax losses for 2001 and 2. Since this only are available to be deducted from future profits. Exactly. So the tax base though needs to be restricted to the extent that there's a probability of sufficient future profits to offset the trading losses. Right? Now, the last paragraph. The directors of Huston should base their focus of the future profitability on reasonable and supportable assumptions. Definitely, because they have focused on that it will increase 20% for the 4 years, the profits. Do you think it's reasonable? Because the market condition is not good, the sale has been declining. How that 20%? So you have to question. You have to be skeptical and question all those assumptions and all. When they predict, when a director makes some focused on future, okay, focused on the future profitability, please question whether it's reasonable or not. So they should base it on what reasonable and supportable assumptions, because if assumption changes, your recognition of deferred tax asset also will change. That's why it's very important that this statement, this line is there in your answer about assumptions and all, focusing and all. So there appears to be evidence that this is not the case. Exactly, in the case there's no evidence that this could be the case. If this is not the case, then please mention it clearly. This is not the case. Hassan has a recent history of trading losses. Exactly, from your background also we have told they have been making significant losses of some 10 something they give. Some figure I forgot now. Go back to the case study and you can even mention it also. And there's a little evidence that there'll be an improvement in trading results within the next couple of years. Exactly, when you're having a history of trading losses for many years, for 5 years, right? Do you think that if you tell someone that in the next year I'm going to suddenly from the losses you're going to make a profit, do you think it's reasonable? Does it make sense? I mean, come on. We all know that it's not something which is not. You should show evidence how you're going to do that. Because definitely to have that profit, it takes time. It's not that 5 years you're making losses, continuous losses, and suddenly in the 6th year you started making profit. So very little evidence is there. They are not saying no evidence. They are not saying it's not at all possible, but evidence is very little. Chances are very little because of your history. So the little evidence that there will be an improvement in trading results within the next couple of years. The market is depressed. See how they are relating to the case study, how they are taking the evidence. This is exactly what we have read now. You also have to put these lines wherever you can put, wherever you can quote from the case study. So the market is depressed. Sales order for the first quarter of 2003 are below levels in any of the previous 5 years. All these are copy paste, right? It is also likely that Huston will incur various costs in relation to restructuring, which would increase losses into 2003 and possibly 2004. Remember the restructuring cost? So for restructuring costs, they are going through that. Various other costs also will come, which will be recognized in 2003, possibly 2004 also. So it will increase the loss further. So only directly attributable expenses such as redundancy should be included within a provision. An expense in 2002, which would increase the current year loss. Exactly. So this provision and expense in 2002 will increase the current year loss. Ongoing expenses may be incurred such as, definitely, because restructuring means what? Ongoing expenses will be there. I have always told you, read the case study in holistic view. You have to consider everything. Everything is related to everything. So restructuring, even though we have answered it in part A, you might be thinking, why in part B I'm putting this here? Because it affects. I'm telling you, this case study is, don't read it in isolation. Okay, part A I have answered, so I will not use it anywhere. Restructuring, throughout the case study you have to use it, even for your losses, tax loss, right? Even though it's in part A, but it's dependent, needed in part B also. So ongoing expenses will be there, retraining is there, relocating costs, but they should only be expense from 2003 onwards, not in 2002, because in 2002 it's future. All these are happening in 2002. You cannot in 2002 expense it, because what did we tell? Ongoing expenses are not recognized as provision. But 2003, yes, because then it will be current. So the forecast profitability for 2003 and subsequent growth rate therefore appear to be unrealistically optimistic. They're too positive, looking at the current situation, which is not match. So they are optimistic is not matching with the current situation. The profitability for 2003, that's a focus, right? So given that losses can only be carried forward for a maximum of 2 years, it is unlikely. Please read the answer, how your answer has to be. Your final answer is like this. Only small piece is your final answer, but look at the number of lines you have to explain the concept. So you should never explain in one line for 5 marks. I've seen students like that also, 2 3 lines they'll be giving, and then they are saying they will recognize deferred tax asset or they will not recognize deferred tax asset. You should never do this. You should give all this facts, all this evidence has to be there before you arrive to that conclusion, before you say whether it will be recognized or not. Therefore, it is unlikely that any deferred tax asset should be recognized. Now, some of you might say that it should be recognized. Okay, but you have to give evidence. You have to give evidence. And this is based on my experience and also my other fellow students and my friends. I'm telling you this. Always go by the marking scheme, the answer which they have provided. When they say, when there are two different views which you can give, whether they should be recognized or not. So if the answer says they should not be recognized, it's a probability, right? They're saying, they are not saying totally, they're saying unlikely based on this fact that they should not be recognized. So it's safe, it's very safe for you to go by their answer, because when you're saying that you should recognize deferred tax asset, then where's the proof, the evidence? You have to come up with your own answer. You don't have a marking scheme for that, so how will you know it? So I would say, don't challenge the answer of the marking scheme, of the examiner's answer. Don't challenge them, go by that. So if they say something, you recognize it, you have to understand how they came to that point. If they say don't, you also have to understand why not. But don't try to challenge them, right? Because I've seen students like that also. They're like, why not? It should be recognized because these are the facts. So yeah, I agree that those could be the facts, but then still it's better not to, go against it. Because the whole answer has been set up for you saying that it should not be recognized. So it's better to go through that. It's more safe. Their answers are more safe, right? So now coming to part C is ethical issue, right? If you see, it's a pretty lengthy answer. Definitely you have to write, you're not supposed to write so much because it's just for 5 and 2 of your professional marks. So professional mark does not mean that you are writing 2 more extra points and getting 2 marks. It is how you're writing, the tone you're using. Are you convincing, right? How are you dealing, the actions you are suggesting, what actions as an accountant you have to give them. So identify any ethical issues and also the implications for the accountant. Two things. So I have read the whole case study. Now you have to use all the facts from the case study. Now here, when it's an ethical issue, don't just give one issue. At least give 2 to 3 issues. Right? So the directors of Huston are paid a bonus based upon what? I will highlight it. The directors are paid bonus based upon EBITDA. It is possible, therefore, despite the losses, that once these items are adjusted for the directors may receive a bonus. A self-interest threat will arise. What? See, when you're giving ethical question, you have to give what thread is there. Remember the 5 threads are there: familiarity, intimidation, self-interest, self-review, advocacy thread. So there are 5 types of thread. Which one is harming at the moment based on the case study? So this is self-interest thread. Self-interest thread will arise. Which thread will arise? Self-interest thread. It's not always. So don't list all the 5 types of thread. Okay, self-interest is this, self-review thread, familiarity thread will arise. No, you have to mention the thread which is very very applicable to this case study. In this case study you cannot say it is a familiarity thread. No, it is self-interest thread. If it's a familiarity thread, they will give you information like they know each other for many years, they have been in the same company, right? So, sentences like this will give you the words which type of thread. Self-interest, why? Because bonus means what? Their own interest, they have their own financial interest there. So it's a self-interest, it's clear from the word. Bonus, any types of revenue, earnings. So self-interest thread will arise. The directors have an incentive. So because self-interest thread is there, definitely there's an incentive to manipulate the financial statements in order to try to minimize the losses and maximize the profit. Because higher the profit, higher the bonus. It's clear, no? Common sense. So directors have an ethical responsibility to produce financial statements which are fair, objective, and transparent record of the entity's affair. Coming to this next. Now, there is evidence that the debtors are willing to manipulate the financial statements in a way directly contrary to the ethical principles of integrity and objectivity. What are this? Integrity and objectivity. They are going against integrity because they are ready to manipulate. That means you are not honest. And objectivity, being influenced, not objective. So it is likely that net expense should be recognized for the termination payments on the assumption that they would exceed the reduction in present value of the obligation from the curtailment. Did you understand this? What does it mean? Net expense should be recognized for the termination of payments assumption that they would exceed the reduction. Because of redundancy, there's a curtailment we previously read in part A, right? When we're talking about the redundancy. Because of redundancy, present obligation will reduce. So there's a reduction, but that reduction is not so much, right? The termination payment is more than that reduction from the curtailment. So because of that, there will be net expense. Deduct the curtailment from the termination payment, there will be difference. So that difference is net expense, right? So net expense should be recognized. So the directors are wishing to recognize this where? Where is its net expense recognized? Within other comprehensive income rather than P&L. Despite knowing that it is contrary to international accounting standard. Net expense, right? Where should it be recognized? Other P&L. But where are they putting it? Under other comprehensive income, it's a net expense. But they're recognizing it under other comprehensive income so that their profits go up. Even though if you record the net expense under P&L, your profit will go down. It's a net expense, right? But if you put it in other comprehensive income, your profit and loss account looks bigger because it is hidden under other comprehensive income, the net expense. So are you understanding the effect? And this is not correct. This is against IAS. They know it. They are very well aware of it. So this would improve profitability. Exactly, although it would not impact upon net assets due to a corresponding decrease in equity. Right? So it will not have an impact upon net assets. Why? Due to a corresponding decrease in equity. So the directors also have not recognized a restructuring provision despite the terms being communicated to staff. Even though they have communicated to staff, they have not recognized a restructuring provision. It is possible that this should be treated as exceptional cost and would therefore would not impact on the bonus. Right? It would therefore be useful to examine the precise time of the contracts in order to assess the potential impact on the bonus. The treatment does, however, at least in the short term, help the company to improve their net assets position. So the deferred tax asset is based upon. Now you're talking about what deferred tax asset. Before you talked about that provision and all. Based upon forecast for too long a period and is also based on unrealistic assumptions. Based for too long. These all are ethical issues. Unrealistic assumptions. Earnings before interest, tax, depreciation, amortization will be overstated as a direct consequence. What happens? Your EBITDA will be overstated. Will be overstated. Net assets will also be overstated and helping the company to meet its debt covenant obligations. It's good, right? If your net asset is good, it's good for the debt. That means your debt is below. You're not breaching your debt covenant. Even though in reality you are, but you're showing that you're not. So you're meeting your debt covenant obligations. So the director's explanation for their proposed treatments are not justified. Directors are appointed to run the business on behalf of company shareholders who are the primary stakeholder. It will be in the shareholders' interest for the company to be profitable and to maintain net assets within the debt covenant stipulations. However, this should not be at the expense of the credibility and the transparency of the financial statements. Exactly. Yes, it's true that they have to maintain that they are agent for the shareholder and therefore they have to increase the profit and also the net assets within the debt covenant. But this should not be at the expense of what? Credibility and transparency. Financial statements has to be credible, it has to be transparent. So there has been a deliberate manipulation. Deliberate means intentionally. They knowingly they have done it. They try to manipulate the financial statements. So deliberate manipulation of financial statements will reduce the stakeholders' confidence in the reliability of the. You are giving the drawbacks now of what happens because of this. So will reduce the stakeholders' confidence in the reliability of the financial statements and the accountancy profession as a whole. So the directors are deliberately floating IFRS to improve their bonus and maintain debt covenant obligations. The directors' actions with regard to the accountant are contrary to the ethical principles of professional behavior. It appears that the directors have put the accountant under undue pressure to falsify the financial statements to meet their own needs. What threat is that? Intimidation threat. When you pressurize someone, an intimidation threat arises from the directors implying that the accountant would lose their job should they not comply with directors' instructions. Now, finally, at the end, you are mentioning this ACC Code of Ethics. You can mention this in your ethical answer, any ethical answer in SBR. So the accountant would also be bound by. You have to talk from the accountant's perspective. What is the implication on them? They have to be bound by ACC Code of Ethics, must adhere to same ethical principles. So ethical principle is not only for the director, it is also applicable for accountant. Accountant also has the same duty to follow, even if they have been pressurized by the director. So they must not therefore comply with the director's instructions. They should not listen to the director. Just because the director can say that I'm going to sue you or you're going to lose your job. Because you have a professional duty, you're an ACCA, you have an ACC code of ethics to follow. So the accountant should remind, what should accountant do? Here is your professional marks. You are saying, right? Where is the here is your professional marks you are getting. The tone you are using, see the tone. The accountant should remind the director. You are advising, it's like recommending what accountant should do. The tone you are applying is where you are getting the professional marks. So the accountant should remind the directors. See, directly you cannot say the accountant should not listen to the director, therefore they must resign. Resigning always comes at the end. That's the last resort. You have to follow that order, my dear friends. That's how you are getting the professional marks. Directly, if you are saying the first step, resign, it's not a good answer. You will lose your professional marks, even though you are correct, you are not wrong. But before you take that decision or tell them to resign or they should not listen, first give some practical reasons, right? First, they should remind the directors of the obligations to comply with code of ethics. Should the accountant feel unable to approach the directors directly, so if the director cannot do this directly with the director, they could consider talking to those charged with governance, right? And in particular, non-executive directors to explain the situation. Yes, they can even talk to non-executive directors. Here you are getting a professional marks, the two professional marks. So the accountant could also seek help from ACCA ethical helpline and they take legal advice. Yes, from ACCA they can take help and also legal advice. If you see the flow of your answer of ethics, pick up any ethical questions from a revision kit or past papers. You will see this. Last paragraph is always this. They're talking about ACC code of ethics. They're saying that they remind this person that they should comply with. If not, these are the penalties they have to do. All those things. And then if they don't listen, resign. So this is the follow the same. So the accountant could also, yeah. Ultimately, if the situation cannot be resolved, see this. If the situation cannot be resolved, then the accountant should consider resigning and seeking employment elsewhere at the end, not at the beginning. So that's it for question number 2. So with this, we finish question number 2 also, and we have 2 more questions left, question 3 and 4, which will be upcoming soon. So take care, God bless, and see you in my next video.